Hey, welcome back to The Dive. Today on the show, we have the founder and managing director of CPM Group. Jeffrey Christian is joining us. He's going to share his insights on Japan propping up the yen, what's happening in the UK, the possibility of a recession, the impact of China's copper bonded warehouse being depleted, and he's going to let us know if he sees more upside potential with gold or silver in this environment. And if you're watching this at home, could you let me know in the comments below where you see the most upside potential? Is it silver? Is it gold? Let me know. Hey, Jeffrey, welcome back to The Dive.
It's good to be back. It's good to see you.
It's good to see you too. Okay, now, Jeffrey, according to the Financial Times, Japan has spent more than $30 billion propping up the yen. What do you think the impacts of interventions like this are on the foreign exchange, and where do you think this might be going?
It's kind of surprising to see it happening. From the time that we floated currencies in 1971 until around 1982, governments spent hundreds of billions, if not trillions of dollars trying to support their currencies. And in the early 1980s, there was this realization that central bank currency intervention could accelerate trends that were already existing in the market. If the yen were falling, you could drive it down lower, or if the yen were rising, you could drive it higher. But that central bank interventions were not effective in turning market currency exchange rates around. And you saw that central banks stopped squandering billions of dollars trying to defend their currencies. And then in 1985, after the dollar had fallen for about 8 months already, 6 or 8 months already, the central banks came in with the Paris Accord and said, okay, now that the dollar's falling, we will help it fall by selling dollars. And they really haven't done much by way of currency intervention since then. So the current spate of currency interventions are kind of surprising because there are obviously signs of desperation. But there's also this vast body of empirical evidence that says you're just wasting your money trying to do this. And what you really need to do is focus on your fiscal policies, and the currency will follow.
Okay, now what about what's happening in the UK? What does continued political instability do to the market?
Yeah, I guess they're calling it brittly. It's like Italy, but it doesn't have the food. Britain has a major problem, and it's a long-term problem. And when they voted for Brexit back in, I guess, 2016, we calculated that they would probably knock 10% off of their economic growth over the coming decade by virtue of leaving the European Union. And I think they have done that. And in the meantime, they've gone from bad policies to worse. And it's mostly fiscal policies that are problematic. The Tory party doesn't seem to have a direction. It's been taken over by Brexiteers. And I guess there is a unspoken realization that it was a bad move, but that having made that move, they're not going to reverse. It's going to be interesting to see what happens in terms of Scottish nationalism and Northern Irish nationalism. And it's quite possible that you'll see both Northern Ireland and Scotland reform, secede from the United Kingdom and form as independent governments and countries that may actually try to reunite with the European Union. So I think Britain's in for a really hard slog. The Tories, as I said, don't seem to have direction. They're doing this blustering carry on with bad policies, and the Liberal Party has no better idea or vision of where the country should go, and the Social Democrats are pretty much powerless. I mean, they may grow over time, but right now they're far too small to assert any rational policies on a national level. So I think England's in for a really tough time, and it's probably going to get worse.
Now, based on what you see now, do you think that we are in a recession?
Well, yeah, I hate to say defining a recession is difficult. I think that we're probably out of the recession we were in the first half. And next week, or no, later this week on Thursday, we'll see the first flash estimate of US GDP, and it's probably going to be positive. We were in a very shallow recession in the first half of this year in the United States. Other countries, the UK and some of the European countries, are probably in a recession right now. Our expectation has been that we will see a recession, a much more significant recession, but that it might not emerge until 2024. And actually, one of the things that's on my plate to do today on my desk, you can see the piles. In those piles are all of my data on revising our 10-year projections for GDP, economic growth in major countries and major regions. So we'll be revising that now. Our most recent revision, which was in July, had the world and the industrialized world avoiding a outright recession in 2023, but seeing really low growth in the industrialized world, followed by a significant recession in 2024, 2025. And the question that we have to wrestle with today is, does the recession come sooner? No one knows. Everyone knows a recession is coming. And the title of our Friday video will be Something Evil This Way Comes, with a homage to Scotland. The question is, when will it arrive? How deep will it be, and how long will it be? And really, no one knows. But we think that what we've seen is a precursor to a real recession. It was a recession by definition, 2 quarters of negative growth, 0.6% contraction in each of those 2 quarters, relatively mild and modest. And in that recession, you saw pockets of strength. We think that we're headed to a bigger recession, but quite frankly, I'm not sure if it arrives in 2023 or 2024. I don't think we're in it right now.
So let's move on and talk about copper. China's copper bonded warehouses are now empty. What do you believe the implications of this are across the global markets?
Well, the copper market has been pretty volatile over the last couple of years. You had excess inventories, and now you're seeing very low inventories. Our expectation is that the copper price will rise modestly for the next year or two. There obviously is going to have to be more copper coming into not only China, but in other countries too. And you have this bifurcation of the global economy where China is becoming ever more isolated from the rest of the world. And that's probably going to accelerate as well over the next year or two. So China is going to have issues with its copper supplies, but the whole world is going to have issues with its copper supplies. The good thing for copper users is that we're probably heading into a recession. And even if we don't go into a recession next year, we're going to see very low growth in industrial output. So that gives you some breathing room. But the reality is that the copper market probably will continue to be tight for the foreseeable future.
Now, how are you viewing the recent weakness in the price of gold?
Well, we had thought that the price of gold would fall during the summer months, and we were projecting that it could fall as low as 1680 or 1650. I think it's at 1660 right now as we speak, but it did get down to below 1630. I think it's a combination of factors. One is that you are seeing investors pull back a little bit. If you look at the earlier part of this year, when the gold price got very high, you had a lot of investors who were very worried about inflation. Then you had investors worried about rising interest rates. Then you had investors worried about recession. And then on top of all of that, you had the Russian invasion of the Ukraine. And so you had a number of factors which caused the gold price to go from $1,800 at the beginning of this year to 2,070 some odd dollars by late February. And then it came back down. And it's come off progressively. And I think that that's partly reflecting investors being less concerned about inflation. They see that inflation is coming under control, at least mainstream investors, core investors, not necessarily the gold bugs. But I think the consensus in the investment community globally is that inflation can be controlled. There's some cyclical and there's some secular factors. Those secular factors will have to be wrestled with for years. Inflation is not going back to below 2%, but it is probably in the peaking process and coming off. Interest rates are rising, but there's a realization that interest rates are very low so that they can rise further to quell inflation. That the Fed and other monetary authorities do have tools at place. And that, we are moving toward a recession. So I think we're in this weird spot right now. And, is this the low for gold? Our expectation is it is. And the question is, how fast does it rise? We do think that the price will rise sharply at some point over the next 4 years, but it may not be in the next 4 quarters. It may be beyond the second half of 2023. Like the recession, it's very hard to say when these things will happen. But if you look at the world, you've got problems in the United States, you've got problems in Canada, you have problems in Russia, China, Europe, England, Japan. There are any number of issues that are going to confound and compound the problems that we're facing. And in that kind of environment, I think that investors will continue to buy gold. I mean, the investment demand is high by historic standards. It's off from where it was in 2020. In 2020, investors bought like 40 million ounces of gold on a physical net investment demand for physical gold in 2020. And the price went from $1,200 to $2,000. 2021, 2022, the price has been basically above $1,800 for most of the time. It's been basically trading between, say, $1,780 and $2,000 with a current spike below that. And we think that the price moves back. Investors have probably been buying about 26, 27 million ounces of gold each year, 2021, 2022. That's a historically high level, but it's down from 40 million ounces in 2020. And I think that that's sort of where we are. So we're in this middle ground, and I point out to people when they say, why are gold prices so low? Gold prices will be at a record level this year on an annual average basis. And gold prices on a quarterly average basis have been higher in 2021 and 2022 than even in 2020. So, we're really at high gold prices. Right now, we've got a spike down. Question is it the floor? Does it have a little bit lower to go? If GDP comes in stronger tomorrow on Thursday, do people sell off gold a little bit more? It's quite possible. But we do think that by the end of the year, you'll probably be behind the low for gold and prices will be moving up because they'll be looking at a variety of factors, political, as I mentioned and listed, as well as economic.
Okay, now, do you have a target or any model that you use to assess where you feel the price of gold should be?
I think the price of gold should be $1,660 because that's where it is, and any model that tells you that the gold price should be something different is a broken model. If you have one guy building a model or even one team of economists building a model, and the model has a result that's different from what a market that consists of hundreds of thousands, if not millions of investors and other market participants, that model's wrong. The price indicates whether or not a model is wrong. A model doesn't indicate whether the price is wrong. With all due respect for those people who say that the market price is unrepresentative of reality. No, it is reality, and it is what it is. I think that the gold price probably should be trading between 1,780 and 1,900 over the next several months, but it's going to take a little while to get there, I think, at this point.
So anybody watching this at home, if you could let us know in the comments below where you see the price of gold heading. Now, precious metals have had a challenging year. Between silver and gold, which one do you think has the most potential?
I think that gold has the most potential. Silver may be rising on a spike higher than gold in terms of percentage appreciations. But what we're seeing is that, investors around the world are much more interested in gold right now. And silver is seen as, it's quasi-financial asset, quasi-investment, but it's also an industrial metal. And it's suffering from that there too. I think silver is also suffering from the fact that you had a lot of investors who drank the Kool-Aid in early 2021 and thought that the price of silver was going to spike sharply higher because we were running out of silver, and that there was going to be this investor revolution that would drain the inventories out of COMEX and drive the price up to outrageous levels. And you have any number of investors who are dissatisfied because that pipe dream turned out to be a pipe dream.
So one more thing before we let you go here, Jeffrey. For our audience watching, where can they go to find more of your commentary?
Well, there's several places. The best place is www.cpmgroup.com. It's our website. It's a little bit cumbersome right now, but we're starting to add more things to it. We're rolling out new products that are lower priced and more designed for retail investors, as well as the stuff that we do for large institutions, governments, and institutional investors, and commercial companies like mining companies and fabricators. But it's cpmgroup.com.
Okay, perfect. Well, thank you so much for coming on today and sharing your insights with us, Jeffrey. It's been a pleasure.
Well, thank you for having me.
Thanks so much for tuning in today. We'll be back again tomorrow with the latest news. So be sure to follow along by hitting that notification bell and subscribing below. And why don't you throw us a like while you're at it?